Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, January 20th, 2022. It's 5:32 Eastern Time. Usually I'm shut down for the day by now, but I've been at my desk just looking at charts and figured I'd do another update. As I told you, my frequency of updates on any trade idea, including the markets, is going to be in line with what's going on. So here's the takeaway from this video. I'm going to give you I'm going to reiterate some of my longer term targets, and I'm going to try to speak to the both the less active swing and trend traders, and maybe pass along what might be some tips on how to navigate the next drop down if we are going to go much lower, as I suspect that we probably will, especially after today. So in other words, I'm looking for a drop that'll exceed 20%. I think the odds are well, I know they've increased today based on my analysis. It doesn't guarantee anything, so I'm going to show you levels to watch. Remember, there's no magic light switch that you flip, and if the market does this one sell signal or breaks this one support level or this one moving average, then that guarantees that you're going to go down. This could be just another pullback, and I'm going to go over the support levels. We have some key moving averages and other things, but again, based on everything I've been looking for, that's what we got today, and this couldn't have played out any better. Again, sorry if if it spins your head and it's a little confusing when I talk about the wedges and the likely to break out, but that's a scenario that couldn't be any better for the bearish scenario. That is a textbook false breakout, aka bull trap right there. And I don't care one bit that I gave back a little bit, gamed at, made a little bit on the pop, reversed, then jump back in there, and at the end of the day I had an excellent day. I went back short again when I saw what was going on, and I'm going to go home short. Alright, so I'm going to tell you levels to watch, what might change things. I just wanted to be very clear that today was another check mark for the bears. What I wanted to see, we took out the recent lows, even that reaction low, and we took them out with conviction. Was it end of day selling? Yeah, that somewhat puts a question mark by it. You'd like to see a move happen during the day, not just in the final minutes of trading when there's sometimes position squaring. But it is what it is. So here's the bottom line. I'm going to take it on face value because that's what I've been looking for, and that's what we got. And coupled with the false breakout, everything else. That's our next check mark. So it's going to increase the odds. I'm going to go over reiterate the targets. They haven't changed, and also cover a couple other levels and a couple trend indicators. The video won't be too long. I'm going to cover various time frames on the major indexes. And this was, by the way, the 60-minute chart. That's QQQ. So again, T4 was hit back here. That opens a door to T5 down here if you're a near-term trader. Next stop 352. We do have the 200-day moving averages, so I'll get to those in a second. And we could have another. Sometimes you slice through them a little bit intraday or trade around them, and it's not unusual to see traders step in and buy there. But based on this is where it gets tough. Based on everything else I've talked about, pretty much putting that warning, what we'll call it a crash warning. I use the analogy of the hurricane and tornado warnings. With that being on, I'm more apt to sit tight and wait for the 200-day to be taken out, because we could slice right through it based again on that. In normal market conditions, and I'll show you that in a second here, you pull back to the 200-day when you get too far above it, and that's usually a great buying opportunity. But that's not going to be the case. And just like today, if it fails to materialize, that is uber bearish. In other words, when you fail to have a beautiful textbook bullish falling wedge that either fails to break out, or even worse, breaks out and then gets sold in too hard, that shows a change of character in the market, and that's pretty bearish. So there it is on SPY. You can see, and I've turned off the after-hour trades. That was today's closing candle on the 60-minute chart, where we solidly took out that support. So that's nothing but a check mark for me. IWM, really paying attention more so on the daily chart. We'll get to that. Let's do that now. Let's run over to the daily chart. There it is. So as I said in today's earlier video, you had day one of the breakdown below the key 208.48 level. Remember, that's over a year long extremely well defined, especially the bottom of a trading range, even the top, that one little whipsaw. So day one, little small breakdown. And then yesterday was day two, solid red candle, and today, day three, even more solid. And again, I'm doing this video now, I'm taking this time this evening to do this because you need to be prepared. If you've been looking to short this market for a while, the one thing I always say is that stocks tend to fall a lot faster than they rise. So I'm not trying to be a fear monger. I'm just saying you get your ducks in a row, because if you wait for some golden, every other check mark I'm about to talk about, it's going to be too late, or most of the move will be gone. If we hit that, I think today was, let me go back to a term I've used in the past, something I made up years ago, called the PR, point of recognition, where the bulls, dip buyers, finally, it's that rut row moment for them where they realize, hey, I've been buying the dip for months, it works great, but something's different now. And you finally see that herd mentality shift, and the dip buyers finally start to stop buying the dip, and then that's where you can have those, what I call, waterfall sell-offs. So the potential is still there for a waterfall sell-off. You guys know my sole target for IWM. It'll probably be a stop somewhere in the midpoint along the way, but that got a pretty aggressive target, and I think there's a good chance it's going to be hit. And I'm going to talk about that with Fibonacci's and everything else. There's still, by the skin of its teeth, some potential divergence. If this proves to be a whipsaw, and remember, whipsaws are if it's a whipsaw to the downside, aka a bear trap, then that's bullish. So again, you can back test to 848. You can even go through there a little bit more, but as I said today, 215, really don't want to see that happen. If we just run up here impulsively, then that in itself would be a bullish technical event, and it's going to decrease the odds, at least in the near term, that my 170 target's going to be hit. What is near term? Shoot, we could hit that. It's a 20% drop from where we broke down, 18%. We could hit it in a week. We could hit it in 2 weeks, 3 weeks, somewhere probably within a month is my guess. And probably half of that, within, like I said, maybe let's just say 2 weeks. It's hard enough to call exactly where security is going to go, but to try to call when it's going to get there. And that's why I've said in the past many times, people ask me about options. I long ago learned I don't mess with them. You can use them as conservative strategies, using pairs trade and hedging up, but pure play, if you're just thinking of loading up on puts or calls in certain market conditions, when my conviction's strong, I will take some puts or calls. But for the most part, for the reason I just said, on a lot of trade ideas, I can give you a pretty fair degree of confidence where we're going to go. But if you are buying puts and you think you're going to go there within a month, and all of a sudden I'm right on the call, but we back test, we meander around, it takes 2 or 3 months, guess what? You lost everything on those puts that you bought if you bought the 1-2 months out expiration. So that's why it's better off, especially until you really cut your teeth, and get hone your trading style and get some experience under your belt. My suggestion would be stick to shares, trading shares. If you've got the account value, you can trade futures. There's nothing wrong. Just understand how that leverage works and the roll dates and all that good stuff. All right, before I leave IWM, so that's it. All the key moving averages, I'm going to turn them up a little here, so we'll see them on the other indexes. But we're below all the key moving averages. There's the 200 simple in blue, 200 exponential in red. The 50 is above that. So you've had death crosses where the 50 crossed down below the 200 right here, the simple. And my 200 exponential didn't get turned up. I went the wrong way. There it is. The 50 is about to cross. The 50 EMA is about to cross the 208. EMA hasn't done so yet. If so, that'll be a death cross on that pair. A death cross is simply when you have a pair of moving averages and the faster moving average, and the shorter term that is, so in this case the 50-day, which are too well watched. The 50 and 200 is a popular pair to use for golden crosses, which are bullish when the 50 crosses above the 200. And then bearish when it crosses down below. And I'll go over that in a second. I have some indicators that trend indicators we're going to look at in this video, and it'll show you which pairs have had death cross and which ones to look for. All right, so nothing else to say there. We're below all the key moving averages for the first time in a while. In fact, the last time we dropped below all the key moving averages was right here before the bottom fell out of IWM small caps and COVID, took hold of the markets, and you dropped 39% in a matter of weeks. So you decide whether you want to be long or short small caps. Right now, there's a mountain of evidence to be short, in my opinion. QQQ. This is showing after hour trades. I'm going to turn this off. It's funny, this program, yeah, quite often will give you this wonky, I call it erroneous print, or a candle. That's not today's candle. You look at the 1 minute chart, it'll show you trades that didn't really occur. If they were errant trades. But it never fails to amaze me. I don't know what it is. It always comes down to targets that I already had in place. You can see that's a perfect tag. It's predicting, if you will. Don't hold me to that. It's not really doing that, but that's where I think we're going, down to the bottom of my first target zone at 355.54. Again, that's that whole red skinny part, the shadow of that candle. And so if I turn that off, which I'm going to do now because that really isn't what happened today, if you don't count those 1 or 2 trades, maybe some fool put an order in to buy and they really did get filled to buy QQQ at 335.54. Well, it'd be great if they were short, but all right, let's go here and turn this off. Never. And then you can see, okay, so that's where we close right on. Remember, I had this an intermediate term target there, 360 support. We closed just above it. And you can see the 200-day simple and exponential, and it's not unusual when you come to test them. It doesn't always have to be a perfect test. Sometimes you do bounce right off them. The buyers and the computers as well. A lot of the computers, the algos, we'll call them the machines. They step in and buy it. The pullbacks to the 200. But sometimes you'll cut through it, especially with a lot of what I call momentum fueled overshoot. We had a lot of momentum going into the close. Everybody was kind of in panic mode, and so tomorrow. And this is what to watch for. I'm trying to tell you levels to watch. I could see us come back here and hover on that, maybe even bounce off it. But if we don't, and this is where this is the takeaway, if we just slice through that thing like a hot knife through butter, like it's not even there, and keep going, that's uber bearish. And that's going to tell me that this initial wave, if it's that powerful, that there's likely more to come. It's just going to say, okay, we're in a correction mode right now. Let me give you a tool here. The wave, and if this is, let's just say, a 5-wave move, and this is an Elliott wave. I'm not a big Elliott waver, too subject to revision in my opinion, but they use these wave counts. Primary trends will have a 5-wave with A, B, C, D, E, C always being the largest. So we'll look for things like that, and there's some validity there. But again, you don't hear a lot from me on Elliott wave because it's just too darn subject to revision after the fact, and that's not really good for doesn't give you a lot of predictive value. Anywho, okay, so levels to watch. That's the 200 days. If they get going, and I'm going to go to the weekly charts after this, and that's where I'm saying, look, if you're a swing trader and you just sat tight this morning and rode out the bounce, which also was a bounce back to test the 50-day moving average, it's the yellow line there, then that might be your near-term target. We'll probably most likely have some type of reaction, whether it's consolidation, a bounce, or something when that daily target zone is hit. And one strategy, guys, if you're going to go for the longer-term targets I have in the weekly chart, then if you got in here, I mentioned numerous shorting ops here on this breakdown right here, on this breakdown, on each kickback to the 401-ish area there. And so if you have a nice cost basis there, at this point in time, you probably would have already lowered your stops to entry. At this point in time, what I'd do is lower them right there, above that reaction low. Or you want to even get more aggressive, keep it lower, and then trail it down. If you get to T1, maybe lower it down, back above or around the 200-day moving averages. The more room you give stops, the more likely you are to get stopped out in a bigger trend. However, what I like to do, and I will at some point, is let's just assume this isn't a correction. It could be. Correction could be over today. That might have been then. We'll see. But let's assume I'm right, and we're going to have a drop of over 20%. And maybe even quite a bit more. Let's assume the bull market ended here. Let's just play that game, all right? Just go with me. Or actually right there, that was a high in QQQ. There'll be counter trend rallies to trade, and when the charts tell me, that's when we'll be going long. And I've never missed one in a bear market. I've never missed a bear market or a sizable correction, nor have I missed the big counter trend rallies. The charts will tell me when it's time to maybe cover those swing and even trend positions, game a quick bounce, because the bounces, I love trading bear market rallies. Boy, I tell you, they're just as fast as the moves down and just as profitable. You can get 10-15% or more in a week easy on just the indexes, double or triple that for individual stocks. All right, so before I move on, those are levels to watch. Those 200 days. This PPO trend indicator, the signal line, the white line. If it goes much lower, it will, for the first time since COVID hit, it will cross down below this red line here and tell us that the primary trend has switched to bearish. So that's something to watch for. And another thing to watch for is the RSI. We're coming up, we're a hair above. We're at 31. The oversold line is 30, and we're coming up on that. And in a bull market, you want to buy pullbacks to the 30 level, the oversold level on the RSI. It works great in a bull market. But in a bear market, it's the closest thing we had is if you buy the first pullback to it was right here. You get smoked because things change. In a bull market, oversold is usually fleet, one and done, and then you move on, as it was here, 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 here. But in a bear market, which it was just super fast, thanks to the Fed putting a premature end to it. But even then, you had multiple oversold readings until it was over, and you had positive divergence there. So that's just something to look at. Now, where I'm going with it is as I was saying back here, the bulls, quote unquote, and put that in parentheses, should be stepping in and buying the 200-day. They should be buying the oversold reading. And if they don't, it tells us something is very wrong with this market. If we just slice through there, it tells me there is a tremendous shift in the supply and demand dynamics, and we're probably going to hit my longer term targets, which again I'm getting to here in a second. So those are levels to watch. And then on the SPY, we're coming up. We haven't yet hit the 200-day moving averages. I'm going to get to another chart in a second. You can also see, so here it is. We just today on one hand, we broke that support I've been looking for a long time, 450, right? It was colored in yellow, and we took it out and we made a solid, that's what I'm talking about, a solid close below it. We didn't just marginally, we didn't print a close at 449.20 or 449.80. We closed at 446.75. So that's a check mark. Doesn't guarantee it'll stick, but it increases the odds it will. And then you have the 200s. I'm going to get to those in a second. Or you could just eyeball, put them up on your chart. They act as support on a lot of major indexes. You want to buy pullbacks to the 200 right there and there when we took it out. So here's the history recently. And I have them both up. I always tell you I use the 200 simple in blue and the exponential because some traders use some and some traders use the other. But we broke it there, and then we back tested, and that was a chance to get short. Then we regained it here and said, look, the trend's bullish. We're above the 200s. The only other time in recent years that we were below it, we broke it back in the fourth quarter of 2018. That was about a 20% drop in the S&P 500. Broke it there, back tested, and then had a big drop afterwards. So again, they do a pretty good job, those 200s, of defining the trend. So does that PPO indicator, and so those are the things that I'm looking for. And again, trade it as you think things are going to go. If you're looking for a move to new highs, you can step in here, give it a little room. There's going to be some volatility, and you might have the best entry in a long, long, long time. But if you're bearish and you think things are going to go lower, as I do, still favor that, then you want to use these opposite. If we break the 200s and we back test them, you short on the back test or you short on the break. Add to your positions, that is. Wilshire 5000, probably the most representative of all indexes, even more than the S&P 500. S&P 500 has 500 stocks, but they're the largest in the U.S., largest company. This has everything. It's 5,000, all different market caps, and it's taken out its 200s. Again, this is on a daily chart. It could certainly snap back and close a week above those. But again, coming off the divergences, everything else, I already covered IWM. And then the other index I don't cover often, but we look at once in a while, is Mdy Mid Caps. Mid Caps just took out the 200s, and they are coming up on support at about 470.18 right there. And now let's jump over to the weekly time frame. And that's what the mid caps look like here, since I was already on it. There's that support right there. And let me talk about where we're going. I'm just going to look at all these major indexes and tell you where I think we're going on these. I think we're going to return around to where we were just before COVID hit. These are, and to keep it very simple, I can't tell you what to do. This site is not about giving anybody individual advice. I can just tell you what I would do if I was not an active trader. If I was going to get on a ship today and sail around the world for the next 3 months or more, and I wouldn't have internet, I would set OCO orders. One cancels another. Good to cancel, and I'd have targets down here on that, on there, about 380, 350 or so on MDY. Again, work to be done, but that's where I think we're going, and I'm going to show you a couple other things. And this chart right here shows a custom indicator that I created. It is the percentage that any security I put up here is trading above its 40-week moving average. Now, I don't talk about that all the time, but that is the same as a 200-day moving average, because there's 5 days in a week, right? So if you do 5 times 40, that gives you 200, and that line will come in. It's the same as a 200-day average on a daily chart. So we're looking at it here on a weekly, and it lets you see it better. And so when it pulls back to this line, that means you're 0% above it or below it. You're right on it. And you can see in a bull trend, this is where buyers, as again, they often step back. I don't know why I was just on MDY. I'll go to SPY. Look at all these times in a bull trend. But when you crack below it, that's bearish. This is when you crack below it. This was the biggest drop throughout the last bull market. That fourth quarter of 2018, no, that was 2015 to 2016. There's the Q4 2018 drop. There was a COVID drop. All of those with the indexes clearly breaking below the 40-week moving average. Let's go to the big ones that we trade often. So here's SPY again, as I just showed you on the daily chart, coming up on the 200 right now. When it hits this line, it'll be on the 200. That's what happened in COVID. We took it out. That's what happened in the fourth quarter of 2018. 21% drop. COVID was a 36% drop. And then we had a bear market here with 2 big drops, 15 and 15% roughly. And that's when we took it out. Every other time in a bull market, that's why I said earlier, quote unquote, the buyers should be stepping in. Doesn't mean they will, but if they don't, then that tells me, hey, that's more indicative of a bear market when you fall to the 200 and the buyers don't step in. And again, whether we get a bounce off it for a few days or not, that's usually about it if it's going to fail. But sometimes we do slice right through it. We did that the last time around when COVID hit. We had that big red candle here. You can see a weekly candle right through it. And if it happens so fast, we were short at the top. We gamed that counter trend rally for a nice trade. It can go on the site; they're all there. And then we got short again, and we covered just before the lows there and went long. And that was a nice from low to high. That was a 10% bounce, and we gained most of it if I recall. The targets were on there, SPY, QQQ, whatever it was. But you can see if you missed it, if it happened so fast. You close the week there. Guess what? Again, if you covered your shorts there, which we did on the site, and then you recycled out of it when the target was hit, the bounce targets, you had an opportunity to reshort on the back test of the 200, or in this case, 40-week moving average. So that's that. And again, based on the charts, that's why I think we're probably going to take it out. All right, so QQQ, more juice in the Qs than SPY. I talked about that before. The only time S&P 500 falls as much as QQQ or even more, it happened during the financial crisis. They both fell about 55% in the bear market of October 07 to March of 09, and that's because the banks would have all gone to zero oblivion if the government didn't bail them out. But until they did bail them out, that's where. So the financials had a bigger weighting in the index back then, and that's why you don't have financials in the NASDAQ 100. It's one sector that's lacking there, and it's certainly a decent sector in the S&P 500. So anyway, other than that, usually you'll fall more in QQQ. Not always. And when COVID hit too, you had more exposure to the S&P 500 stocks. So actually the SPY fell a little bit more. This time around, I think tech is overheated, and that's still, I'm preferring to short the Qs and the small cap. Okay, so now weekly charts, and this is again for the swing trader. You want to hold tight. We've now hit my first target for a roughly 16% gain. Remember, I measured that from the top. We had numerous shorting ops up near there, and now first target's hit. I still maintain this third and current final target, which is 268-ish and or the uptrend line right there, although I might extend that to this level here, which would be the top of what I call the pre-COVID high, the pre-COVID drop before we fell. Market peaked in February, and that's going to be, if hit, and I'm just trying to give you perspective on this, and this is where you can then calculate your risk reward, how much stops if you're holding. That's a 42% drop if it gets there. So we hit the first target. We also, a little reversal stick off there. Hold on, this might have the after hour trades. Let me make sure it doesn't. There it is. Okay, that was that erroneous print. I'm sorry about that. I should have realized that. That looked a little long to me. No, we didn't hit my first target yet. We parked just, of course, we parked above the 40 week. Remember, I'm still a little fuzzy headed. Bear with me, guys. It's still got the COVID. In fact, I took the test today with a home kit. I knew I had it because my wife tested positive, but it's official. So still got the whatever you call it, antibody, antigens, whatever going on. T1, I said T2, roughly 20, 299.15, T3 268.30, about a 34% drop, and then that trend line. I said and/or trend line because sometimes it depends on how, if and how you get there. If it's a long, slow move down with a lot of counter trend rallies, it could take a while, and the trend line comes in higher and higher. But things get ugly, so I'm gonna add it here now just to tell you this is a potential fourth target. And then we're gonna go to Fibonacci retracements, then the monthly charts, and we'll wrap it up. Potential T4. So again, how to trade it. Randy, you're telling me about how the buyers could step in here and blast off on the 200s. We're oversold, blah, blah, blah. Again, if you're swinging for the fences and you're less active trader, the only way to effectively trade it, in my opinion, give yourself wider stops. Allow for a wider stop. Look, there's one level right here that should not be regained. That's this uptrend line, which has been broken. So maybe a back test of that. Even where we closed today. Look, I'm not a proponent. I was more apt to get in short here. So if you did that, you can put a stop above or even at your entry at this point or just above it. And at worst case, you're going to lose profits that you made so far. And if you sit tight with that wide stop, you've got another 34% if that's hit. And there it is. You can see it here. There's that pullback to the 200s right there. And this is what happens if you buy the 200 and it doesn't work, and it happens quick. So that's why I'm doing this video again, because things can happen very fast. Let's see, what did I cover? The mid caps already on the weekly. Yeah, no, I didn't, but here it is. Same thing. There's that level taken out. There's a weekly stick. So here's the thing too, guys. I'm on the weekly charts now. The market has the potential to turn around and rally tomorrow. I put nothing, and I mean nothing, above this government and this Fed to pull any rabbits out of the hat that they can. The Fed knows that they're boxed into a corner. They have to raise rates. Inflation's out of control, but yet they don't want to be responsible to crash the market. It happened back here, and you guys remember in 2018, I called this top here, got in the correction, and I said this: the Fed was starting to get hawkish here, hawkish speak, and I said when this happened, I predicted the Fed would pull a 180, and that's exactly what happened right here. And when that fourth quarter 2018 drop ended, they pulled a 180, and they went the other way, complete full-on dovish, and they remained full-on dovish until just recently, when they just could not, Powell couldn't hear himself speak the idiotic, transitory inflationary forces anymore. He just had to finally concede that he was wrong on that. And so where I'm going with this is the market will throw they're starting to throw a or they call it a taper tantrum. But what does he do? His hands are kind of tied. His hands weren't tied in 2018. He just didn't want the wealth effect to be destroyed. The wealth effect is what has kept this market afloat for so long, especially since the COVID lows here. And I'm going to get to that in 1 second too. So I don't trade on what the Fed can do, might do, what the White House may do. If they do something, it may have an impact and it may not. That's the funny thing, guys. The market, when the market is in bull mode, rally mode, Good news is good news, and bad news is good news, or ignored. And likewise, when the tide finally turns, it goes the other way. Good news is ignored, and or spun around as bad news in some way or another, and bad news is bad news. So, and I'm going to get to that in a second, because what's going to happen if my targets are hit, I could already write the headlines for you for the next 6 months or 3 months going forward. Change in new home sales, home orders being canceled, boats. I told you I bought a boat recently. The company I bought it from, they're back ordered like 2 years. There's a frenzy because of the shortages right now and the demand. And I've got a friend that's got an order on a boat, and I told him I guarantee it'll be like a year and a half, 2 year waiting list. I said, watch, this market's going to take it on the chin soon, and when it does, you're going to see a flurry of cancellations. Everyone right now is playing with free money. They're playing with profits from this huge rally in the market. They're playing with PPP money from the payroll protection plan that was given out to businesses and everyone else. They're playing with the free government checks and everything else. So if this happens, and I'm going to get to this in 1 second, show you what it's going to do to the economy. But there's your target on IWM, and let me start looking at some fibs right now. And again, from the highs right there for small cap investors that are buy and hold, and God bless them, they didn't get shaken out during COVID, and they held through that. They were rewarded and then some. And what it does is in the markets over time, and this is why technical analysis works. It's all about mass psychology and the masses, and you're rewarded. We always use that Pavlov's dogs, analogy, and people are rewarded. But the one I use sometimes too is B.F. Skinner. He was big on negative and positive reinforcement, electroshocks, things like that. So right now the dogs, or people, I should say, have been rewarded for just holding on no matter what happens. The market's always going to go up, and when that starts to when they start to see those profits come back, we don't have to have the R word, recession, but it's very possible, and it's a vicious cycle is what I'm trying to say. Here, let me show you before I get to my Fibonacci targets. Okay, according to a quick Google search, I can't verify the source or accuracy of the source, I should say, but what's reported is total market capitalization of the U.S. stock market as of December 31st, 2021 was 336 and $436 trillion. And so what I see in the charts right now, and again, unless anything changes, unless these key levels hold, if we flip over into my longer term trend indicators, you can see some of them down below, and that target's hit, looking at a 30% drop, and comparable in the large caps. That would be a $16 trillion evaporation of wealth from the pockets of the U.S. consumer. Consumer spending, as we all know, accounts for about 2/3 of GDP. And so, again, you wipe out 30% of everyone's 401k, and I'm speaking on balance here, $16 trillion vanishes, then you're going to see people tighten the belt. And then that has a domino effect. It affects the housing market, it affects auto sales, it affects everything else. Okay, and while we're on small caps, I'll get away from that, but you have divergences across the board. You're coming right now, you can see here the PPO, and that's this one here, that's the percent. You can see the small caps have already clearly taken out, as I told you earlier in the beginning of the video on the daily, taken out the 200-day moving average. This is a level I'll be watching. I have a lot of long-term indicators, trend indicators. This is just one of them, and I love it. It works so well on so many securities. Not everything. It's that simple PPO 9 EMA. Just look at the zero line. When you're above it, when the white line's above it, the trend is bullish. You want to be long, and when it crosses below, as it did right here, it tells you the trend has switched to bearish. It caught that bear market in small caps. That was another bear market, a drop of 20% or more. That certainly was. And so you can see we're going back for years. It caught almost the entire bear market from 2007 to 2009. again, zero exceptions. So, and we're close. And so what happens is, and I talked about this the other day, sometimes you stare at the edge of the abyss and, and it stares back at you. But look, there's a bounce. Sometimes you come back and the line acts as support and resistance when tested from above and below. So I'll say it again, and I know you probably hate to hear it. You want to hear what to do, where do I put all my money? Watch it here. It's going to take a little while to have confirmation that this level was defended. But if the bulls can step in and keep that up, they're keeping the bull market, that one trend indicator. That's not everything, but they keep it going. Solid cross below, especially on a weekly closing basis. And we've now flipped this weekly trend indicator to bearish, and that will also increase the odds that my target's going to be hit there. Real quick, because I know the video is going longer than I wanted, but again, a lot of stuff I want to get out of here today. S&P 500. You have my longer term targets are down here. There's the top, right? Really, technically, the top of the pre-COVID highs is in the middle. These two. This is called a support zone, 354 down to 324. But if you look at, there's the top right there, about 342. Now let's play the fib game. I put up Fibonacci retracement levels, and what I'm doing, the way these work, that was a major reaction low. You can't miss it. And since then, this has pretty much been a near unidirectional uptrend, a few little corrections. So this is where you put your fibs from the low back in March of 2020, when markets bottomed out when COVID first took hold of it, up until the recent highs. We're going to assume that that is the high, which I believe it'll be, at least a significant high. Now we look at Fibonacci's, because Fibonacci's help us to gauge where typical retracements, these are called Fibonacci retracement levels, and they're based on percentages, 38.2, 50, 61.8. There's some other levels, and those are just run-of-the-mill correction points. And so just to do it's not minimal. They have a 23.6, 78 point. There's different ones out there, but just that minimal one right there, the 20, to come back to the 23 6 or 38.2 fib is going to take us down 21% off the highs. So a lot more downside. To come down to test the pre-COVID highs right here is going to take you between the 50 in the 61.8, and look at this, those line up. Remember, I had, and you guys have heard me say this before if you followed me for a while, it never fails to amaze me that I mark my charts up. I always first and foremost mark my levels based on price, support and resistance levels, trend lines, price resistance, and it never fails to amaze me how well, when I mark up the charts, that those levels come in with the fibs. And you can see that's it's almost exactly my the long-term targets I've laid out since before we even peaked back there, 354 and roughly 325. So is it guaranteed they'll be hit? No, but if it does, and I say this because I know a lot of people sometimes probably think I'm aggressive or crazy with my aggressive targets, but that would be it would simply be a 50% or 61.8 retracement, and based on the fundamentals, what I think the fundamental outlook for the market, I could easily see a 50% drop in this market. So do the math, and maybe I'm wrong. God knows I've called enough potential tops over the years, and sometimes they pan out, and believe me, there's not a correction or bear market I've missed, and there's many that I thought we were going to see more downside and we didn't, but that doesn't stop me for reading the charts the way I always read them. And this is what I see here. So there it is, guys. And that would be, again, a drop of about 20, let's say that one, which is also my price resistance level, 28% or so, down to about potentially 33%. So again, do the math on the wealth effect. If that happens, it's going to affect more than just the stock market. It is going to affect everything else in the economy, tourism, auto sales, the airlines, restaurants, you name it. It's all tied in together. Economy is one living, breathing organism, and it's just all those parts are interconnected. Okay, QQQ. Price targets I gave you. Again, these have been laid out for a while. T1, T2, 3, I already covered these. And there's the COVID. That's the one I just said, potential T4. I've had the level there for a while, as well as a trend line. I don't know if you noticed that. I've had that trend line come in. 235.33, and that is the peak. What I call the pre-COVID highs, right before markets fell off a cliff. Now let's put up the fibs, which which I've already done. And you can see that that would take us down to a little bit deeper. And so this would be a 61.8. That's a pretty aggressive correction. The NASDAQ is powered up. NASDAQ went a lot higher. And that lines up perfectly with price support. And one of my targets right there, about 260. If we come down here, that's a 78.6. I added that just to show you, if things get really ugly with the tech sector. And there's that low. So again, that's roughly what I'm looking for. So let's just say right now a minimum swing target. There it is. That's the number I used earlier with the wealth effect and with IWM. 32% drop off the highs. So which gives you another, if that happens, another 29% or so, almost 30% downside. And again, if it happens or not will largely depend on what happens here, because now we're at those key moving averages, and you can see, they usually buy them. They did when COVID hit. They stepped in hard. They rallied it up. From that, we undercut it that week. I'm measuring the low of that candle, bounced a full 10, 11%. I told you we gamed that bounce long on the site. Went long there, covered shorts, went long, and then got short again and covered just before the bottom there. But that's a level to watch, because when it gets taken out, that's usually a good buy for the market. It gets taken out. Sometimes I'll back test it for a few weeks like they did there. They even came in one last shot, couldn't do it, boom, another leg down. Other than that, it is a great trend indicator. If you are bullish and you don't share the same mindset as me as to where we're going over the next few months or this year, I'd be buying with both fists right now, honestly. And I'd have a stop somewhat below. The wider the stop, the better. But just don't underestimate what can happen if you get a crowded rush for the exits. So that's the whole point of this video. All right, last but not least, I talked about other trend indicators. I might have to get to those in another video, but before we leave this, again, we're on QQQ, 200-day, 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 200-day. What else did I have for you? The Wilshire, I think I covered the S&P 500. Yeah, I did. Wilshire 5000. Nah, I don't have that one marked up for the fibs. Doesn't matter. Let me just go to the weekly or monthly charts and then end this for you. Okay, so the monthly chart, again, one of my beloved indicators is this PPO histogram, which is the same as the PPO crossing over, making these bearish crossovers. We had one right there. Sometimes it'll act as support, it'll test and bounce, and it just does a great job at finding trends. So let's go real quick to SPY. I've covered this a lot in the past. SPY is comfortably above there right now. Well, that's relatively speaking. The levels at point, no, that's right here. PPO is at 10.46, but you can see these lines have clearly, PPO is clearly rolled over and it's pointing lower. It looks like it wants to make a cross. Sometimes they kiss. I'll be watching this. We've got another 10 days, 11 days left on the month. That certainly will be something to watch, because as I've gone over, without any exception, every time we've had these crossovers here, they've been associated with drops, especially in the NASDAQ. I might add some little whipsaw right there, but other than that, it's just done a great job. It's been associated with big drops. That one's not measured out there, 57%. QQQ already, as I've told you recently, clearly crossed. And sometimes these, these are relatively brief corrections, 26, 24, 31, 55%. But this is where you've got to be careful, because all these bear markets, every bear market occurs early on. You get that crossover, the trend changes. The PPO is a trend indicator. When the histogram is waning and moving down, the market's still moving up. It just shows you momentum is slowing and the tide is about to turn, and eventually the tide turns. And right now, we are well below there on QQQ, well below there on IWM with that crossover. It is a monthly chart. All that matters is how this closes out on January 31st, assuming that's the last trading day of the month. I haven't looked at the calendar. I don't know if a weekend falls there, but last trading day of the month, we'll finalize that. And if we don't have anything, and so far we have a correction, but not to the scale of these previous corrections. And so that's why I think there's a lot more. And then let's wrap it up here, and I'll go over trend indicators and all that later. I've already mentioned we had some bearish or death crosses on the 250, some indexes, but not all. But I'm seeing just mounting evidence, and a lot of these things are starting one sell signal after another, one trend indicator after another. And as we get the sell signals, we're already done with the 60-minute charts. We've given, we had the main sell signals were weeks ago. we've been short. Now we're turning our focus to these weekly and monthly charts, and this is a monthly chart that I'm on right now. There it is right there, monthly. All right, let's wrap it up here and pick it up tomorrow, because tomorrow should be a big day. I'm dying to see how they close it. Are they going to keep everybody guessing? Will there be a rally back up? No matter what happens on IWM, I think at this point in time, any rallies back to the level could be used to add on to shorts. And on QQQ and SPY, are they going to step in and defend the 200 days? Oh, no matter what they do, unless it's a big move down tomorrow, unless we slice right through them, if we consolidate by the end of the day tomorrow and we end up on or near those, it's going to keep everyone guessing for the weekend. So I'm going to tell you that now. You're going to have to make a decision by 4 p.m. tomorrow whether you want to go home short or long. And just as I did last week, I made clear that heading into last weekend that I thought it was favorable to go home short, and I will tell you the same tomorrow. It's hard to say right now. If I had to tell you right now, I'd say stay short. But again, we have a whole other trading day to watch tomorrow, see what happens, and we'll pick it up then. This has been Randy Finney with Right Side of the Chart. Have a great evening.